Welcome back to another explainer. Today, we're literally putting on our detective hats. But hey, instead of dusting for fingerprints or analyzing a crime scene, we're digging into something that can honestly be just as thrilling and just as full of hidden secrets, a company's true financial health. Seriously, forget the idea that accounting is just some boring chore where you punch numbers into a calculator all day. No way. It's an investigation. It's this relentless pursuit of absolute reality. Because when we look at a company's raw financial data, we aren't seeing the truth. We're really just seeing the starting point. So today, we're going to learn exactly how to uncover the real story.
And just to set the stakes right out of the gate, let's talk about the Enron disaster. This was one of the most catastrophic financial collapses in modern history. And why did it happen? Well, because the financial truth was hidden. The numbers reported to the public were aggressively manipulated, which completely obscured massive debts and failing businesses. It's a massive cautionary tale. Accurate financial reporting isn't just about ticking boxes for compliance or, making regulators happy. It's literally about survival, transparency, and understanding the massive, real-world stakes of getting the numbers right.
Okay, let's dive right into this by defining exactly what our primary investigative tool actually is today. We call them year-end adjustments. These are absolutely crucial accounting entries made at the very end of an accounting period. And their purpose, it's to allocate income and expenditures to the exact correct period they belong to. Think of a raw trial balance like a blurry photograph. Year-end adjustments act as our truth serum. They're our camera lens, sharpening that picture so that the company's financial reality is crisp, accurate, and completely transparent.
Here's our roadmap for today's explainer. We'll be looking at 1. The true financial picture. 2. Calculating asset depreciation. 3. Provisioning for bad debts. 4. Income received in advance. And finally, 5. Finalizing the statements.
Kicking things off with Section 1, the true financial picture, investigating the raw data. Say hello to our fictional case study for the day, Piano Pulse. They're a super dynamic company in the music business, and they've just handed us their raw, year-end trial balance data. Our job as financial detectives is to investigate their books to uncover what's really going on. Now, the numbers they currently have written down, they look great on the surface, but we know better, right? We know that without applying the correct adjustments, those numbers are totally masking underlying costs and unearned revenues.
So to get to the bottom of this, we really need to know the specific rules of the game for Piano Pulse. Here are the accounting policies and timelines we've got to apply to their raw data. For equipment depreciation, they use a 20% reducing balance method. For vehicle depreciation, it's a 5% straight line method. They also have a pretty strict bad debt provision policy of 20% of their accounts receivable. And, this is absolutely crucial, their financial year ends on February 28, 2024. Definitely keep that date in mind, because timelines are literally everything in accounting.
Moving right along to Section 2, calculating asset depreciation, the wear and tear.
That brings us to our very first suspect in this investigation, asset depreciation. This is that invisible force that just slowly eats away at a company's asset values over time through good old-fashioned wear and tear. Now, as we saw in the rules, there are 2 different methods at play here. Let's contrast them real quick. The straight-line method is incredibly simple. It just calculates a fixed percentage on the original cost of the asset. Like, if a vehicle costs 200,000 Rand, 5% of that is 10,000 Rand every single year. Boom, done. But the reducing balance method, which they use for their equipment, requires a bit more digging. This calculates a percentage not on the original cost, but on the carrying value, which goes down every single year as the asset loses its value.
Notice how beautifully logical the reducing balance calculation flows when you break it into 3 specific steps. First, we find the original cost of the equipment. Just for the sake of understanding the mechanics here, let's say a single piece of equipment costs 100,000 Rand. Second, we absolutely must subtract the accumulated depreciation. That's the value it's already lost in previous years, which in this example is 20,000 Rand. That gives us our carrying value of 80,000 Rand. And it's only now, in step 3, that we take that carrying value and multiply it by the company's 20% policy rate.
Now, if we follow those exact steps for the entirety of Piano Pulse's unique equipment portfolio, it yields a total adjustment of 36,000 Rand. That 36,000 Rand is the final depreciation expense that we need to adjust in the statements to reflect the true aggregate loss in value of Piano Pulse's equipment for this entire year.
All right, Section 3, provisioning for bad debts, anticipating losses.
Let's turn our attention to our second suspect, bad debts. This is such a critical area because, just because a client owes Piano Pulse money and it's written down as revenue, it absolutely does not mean the client is actually going to pay it. We have to anticipate those losses.
Let's see how this builds our bad debt adjustment. Piano Pulse has an accounts receivable balance of 50,000 Rand. Step 1, we apply our 20% rule to that 50,000, which gives us a target provision of 10,000 Rand. That's the total safety net we need. But step 2 is vital. We check the books and see, there's already an existing provision of 5,000 Rand from the past. So step 3, we don't just blindly add 10,000. Instead, we subtract the existing provision from our target to figure out exactly what we need to add this year.
So, the crucial point here is that our new adjustment amount for this financial year is exactly 5,000 Rand. By adjusting the accounts by 5,000 Rand, we successfully bring our total safety net up to that required 10,000 Rand level without overexpensing the current year. Pretty neat, right?
Moving on to Section 4, Income Received in Advance, a Timeline Trap.
Next up, we shift our focus to the third and, I'd argue, trickiest area of our investigation: income received in advance. I like to call this a timeline trap, mostly because it involves money the company has physically received and is literally sitting in their bank account, but they haven't actually earned it yet. I really want to pose this fundamental accounting question directly to you. Why on earth is income received in advance considered a liability and not an asset? Just think about it for a second. If you have cash in the bank, your instinct is to celebrate. Cash is good. Cash is an asset. So why would accountants look at money in the bank and call it a liability? Well, this brilliantly illustrates our core dilemma. The answer comes down to one word: obligation. If Piano Pulse gets paid for services or rent, but they haven't actually delivered that service or provided that space for the time period they were paid for, they essentially owe the client. Think about it. If the business completely shut down tomorrow, they'd have to refund that money. That obligation is a huge burden. Therefore, until the calendar actually catches up with the cash, it is strictly classified as a liability.
Let's walk through this mentally to see how it traps us. Remember that strict cutoff date we talked about? Piano Pulse's financial year ends on February 28, 2024. However, their records show that they received monthly rent payments of 10,000 Rand all the way up until April 2024. March and April are clearly way past that February 28th cutoff line. That is 2 full months of rent received that simply do not belong in this current financial year.
Because there are 2 months at 10,000 Rand each, this calculation means exactly 20,000 Rand must be boldly stripped right out of the current year's revenue. We literally have to create an adjustment to remove it from income and reclassify it as income received in advance, a liability. Finally, we're at Section 5, finalizing the statements, the truth revealed. Okay, we've tracked down the depreciation, wear and tear, we've anticipated our bad debt losses, and we've completely untangled the timeline trap of advanced income. Now, we pull all of these calculated clues together. This is where all of our hard investigative work pays off. Our newly calculated 36,000 Rand depreciation expense and our carefully deduced 5,000 Rand bad debt provision seamlessly slot right into the statement of profit and loss. You'll also notice other adjustments from their broader files here, like prepaid rent and accrued interest. Every single line item we're looking at has been thoroughly vetted. It's not just raw data anymore. It's a refined, accurate, and completely legally sound picture of Piano Pulse's operations. So I'm going to leave you with this final provocative thought. If we hadn't made these year-end adjustments, how dangerously distorted would Piano Pulse's apparent profit be? I mean, they would have looked way more profitable, but it would have been a total illusion. Without these adjustments, equipment decay is completely ignored, inevitable bad debts are treated like guaranteed cash, and unearned liabilities are just masquerading as revenue. This perfectly captures the immense power and honestly the ethical responsibility that accountants hold in shaping financial reality. Because at the end of the day, when you understand the adjustments, you understand the truth. Thank you so much for joining me on this explainer, and keep questioning the numbers.